The market is open and we can see right across the board some patches of some large red drops for certain companies, and that is because earnings seasons has started. And today our focus is going to be on United Health Group that reported before the market opened today, and we can see the market has ultimately reacted in a negative way. Right now down 8%, it was in fact down 10% at the beginning of the market open. It is also one that we hold in our own portfolio, and as we can see, Wall Street do give this a strong buy, Seeking Alpha giving this a buy, and Quant as always giving this a hold. So let's dive in, understand what's gone wrong with this company with their earnings, whether or not we are adding to our position, and our overall thoughts. First thing, as always, we do like to dive into their earnings report, and as we can in fact see, they beat on both the revenue and earnings per share, so we are off to a great start. However, we do notice here that they did revise their annual profit guidance, which can't be a great sign given the fact the market has dropped. We do have to go with the assumption they've revised it in a negative way, and they also have this healthcare cyber attack still on top of their heads. So let's look at the numbers, understand how they've performed in terms of the strength. EPS 7.15, always great to see when it's up from the same quarter a year ago at 6.56, and they also outperformed the analyst targets of $7. So nice beat as well as nice growth from last year. Revenue up 8.5 billion, that is a 9.1% growth year on year. And as we will go across today, we're going to talk about why we love this company and why it is a very large staple in our own portfolio. They reported 100.8 billion, as we can see a nice beat on the 99.28 billion that the consensus market had estimated. Now we also note there is some fallout from that cyber attack still in this quarter, and we can in fact see that was around 0.3 billion in that issue, so something that still looms over their head. Now, in terms of other metrics that the market likes to see, it is the medical cost ratio, the MCR, and for those that don't know, a lower ratio is typically better in terms of the profitability of the overall company, and it is in fact higher than what we saw last year at 82.3. So not a great sign in relation to this specific metric, but the real thing that is starting to drag this company down, as we can in fact see, is that the guidance that they have revised now, the 2024 net profit of 1570 to 1575 is in fact down from what they had discussed in the previous quarter of 1595 to 1640. In fact, quite a large drop, as we can see. The upper end was 1640, the upper end now from that revised guidance at 1575. We also noticed they have lowered their earnings per share outlook 2750 to 2775, and as we can in fact see, analysts targeting 2770, with in fact last year this sitting around 2750 to 28. So a quick conclusion, let's wrap this earnings up. UNH, they performed very strongly. It was an EPS beat as well as a revenue beat, things we do love to see. But not just with UNH, especially with other companies that are reporting, the market is going to look very, very strongly at what the guidance is. They want to see at a bare minimum reaffirming the guidance, but in an ideal world, they want to see them revised towards the upside. Unfortunately, UNH, both in terms of a net profit aspect as well as the earnings per share, have lowered their full year outlook. So something to consider with this company. When we do go back to it, we do want to point out year to date, it is up around 15%, so underperforming the S&P, which we will compare to later. Over the last 12 months, up 12%, again underperformed the S&P. But over the last 10 years, this is a company that has some strong growth, up 578%. And in fact, when you do zoom out, has massively outperformed. Now, currently, it is still trading in the mid to upper end of the 52-week range. It does offer a nice forward yield of 1.39%. We're going to discuss this in a bit because we do love the fact they continue to increase these dividends at a double-digit rate. And right now, the forward P sits at around 21 to 22, which is lower than the S&P 500, right now sitting around 24. Now, let's get into how they performed historically in terms of the earnings. And what we can clearly see over the last 4 quarters, in fact, they reported today on Q3 earnings. So we can, in fact, say over the last 5 quarters, this is a company that you do get a lot of confidence in. They typically beat, and by quite some distant, management targets. So they have a 100% track record. And over the next 3 quarters, we can see they are anticipating high single-digit growth, and in fact, 2 of the next 3 double digits. So lots to love about this company. They are still growing, as we will show you through other metrics, and the EPS for December 2025 at 31.17 will lower that forward P down to 19.42. Now, as we said, we want to show you the metrics behind what we would consider a high quality company. First thing to point out, dividend safety score 99, very safe. That is the highest score obtainable. We're going to talk about dividend yield theory as well as the essential valuation based on the forward PE. But as we did just discuss moments ago, they did increase their dividend this year, in fact in June, at 12%. Now, for those that want to know, it was reaffirmed at the end of July, and very safe score means that a dividend cut for United Health Group is highly unlikely. Now, how were their key metrics? This is specifically from the 07-09 Great Recession. They maintained the dividend, so bear in mind they didn't increase it, they also didn't cut it. They had plus 5% recession sales, which was well above the average of the S&P at negative 12. However, they did trail the S&P in terms of return, negative 63, the S&P itself, negative 55. One thing we love about this company, we would consider it a dividend growth company. Double-digit increase over the last 5 years. Double-digit increase, in fact 41% year on year in terms of dividend growth over the last 20 years. And we can see they have been increasing those dividends for the last 14 years whilst paying a dividend for the last 31 without a reduction. Now, this valuation method is solely based on the forward PE, something we will consider, although we have our own valuation model to look at shortly. What we notice is that the blue tunnel is essentially the expected fair value, and for the majority of the last 12 months, it has been some way away sitting in that point. What we notice right now, though, it is trading right towards the lower end, and we could ultimately see this come into undervaluation territory solely based on this model. We also like to draw your attention to dividend yield theory, something else that we do discuss here, which says a company is undervalued when the current yield sits above the 5-year average. So you could argue slight undervaluation now based on the drop today, and the same to be said for the forward PE. Currently trading at 19, which is below the 5-year of 20, so another slight undervaluation signal. When we do take a look at it in terms of the sector as a whole, healthcare PE is at 16.4, so UNH does trade in fact slightly higher. You could argue that high quality companies do deserve to trade at a premium, but remember, we're not looking at any one of these valuation models in isolation. We will conclude when we come to our own valuation model towards the end. Remember, free cash flow, we do ignore earnings data. It is susceptible to manipulation by management through accounting. Below 60% is what we target. Look at the consistency in these numbers. We're talking around the 20% every single year, which is why they can consistently offer those double-digit increases. 27% over the next 12 months. So we would be really surprised if we're sitting here in June 2025 and they haven't done another double-digit increase to the dividend. We then move on to the free cash flow per share. We want consistent growth over the longer term. That is exactly what we get from UNH. 671 in 2014, 2770 in 2023. So we're talking about around 4 times growth over the last 10 years. And over the next 12 months, that increase, that train of growth is expected to continue at $31.20 per share. So good so far. Then we move on to the sales growth, where in fact we're looking at 3 to 7%. Remember, 3 to 4 is the bare minimum just to keep up in line with inflation. UNH, nearly double-digit growth every single year, 12 to 15% over the last 3 years, 11% on a trailing 12-month. And for those that want to see the numerical format, well, we can see nearly triple growth over the last 10 years, 130 to 372 billion. Now, as always, we like to flag these shares outstanding because ultimately we want to see share buybacks, returning excess cash to investor pockets. UNH, very minimal on a year-on-year basis, not something we tend to discuss too much about this company. Nonetheless, even a little bit is an added bonus to the investors. Remember, you are gaining a greater portion of the company. Now, this is one metric we always like to focus on in terms of identifying high-quality companies. We want 10% or more. Give us faith, management are able to effectively allocate their capital. They're looking incredibly good, incredibly consistent, 19% over the last 5 years, 18% on a trailing 12-month basis, making it incredibly attractive to investors. Now, operating margin, we want to see above 12%, but not just that. We want to see efficiencies. We want to see growth year on year on top of the revenue. That is typically a high quality company identifier. And what we in fact notice here is that it has been lower than that every single year, but we do want to point out this industry as a whole, when we look at similar companies, the margins are very, very similar. So nothing that we would say is a red flag indicator, just something to know about the industry as a whole. And the free cash flow margin around the 5% level year on year that we do want to see for this industry as a whole. Now, final metric is the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 3. And for those that are new to the channel, these numbers below refer to the number of years it would take the company to pay off all of their debt net of cash on hand. Remember, this metric correlates to dividend safety, balance sheet strength, and what we see here, below 3 every single year, 1 in 2023, expected there or thereabouts over the next 12 months. So they have a phenomenal balance sheet. No surprises as well why we get that 99 dividend safety score. Now, we also want to flag we've released our latest free weekly article. We drop these every single Monday morning to your inbox, where we talk about what's happened in the market over the last few days, as well as covering undervalued stocks that we do believe deserve your attention. So click on the pinned comment below where you can sign up and read straight away. You will also be able to gain access to 36 undervalued dividend stocks for the month of October. We run through each one, a lot of information, as well as the upside that Wall Street see. Remember, each one of these we do see as undervalued, and we also flag, for those that are interested, those that sit within our own portfolio. On top of that, you can get another spreadsheet which covers 22 undervalued dividend stocks that Wall Street themselves believe have the most upside over the next year. So remember, click on the pinned comment below, sign up, and you can read and take these spreadsheets straight away. Other parts of our analysis include looking at insider and institutional movement. Insiders around 0.33%. In terms of selling, 108 million over the last year. What we notice though, in the more recent quarter, there's been no movement. In Q3, we see 2.5 million worth of sales. In Q2, no movement, and Q1 around 1 million. Now, for full transparency, we can show you who these insiders are, and the more recent one was the 18th of July. You could say this is fairly outdated. We noticed around 1,500 worth of shares being sold for under 1 million in terms of net gain. Remember though, we don't see this as a bearish signal, we're just flagging it because we ideally want to spot bullish signals which are insider buying. Now, institutional ownership, 88%, around 24 billion worth of sales over the last year. A little bit more buying, 29.6 billion during the same time period. But we noticed in Q3, so the more recent quarter, a lot more buying than selling. In Q2, the exact same thing. In Q1, we noticed the opposite. So in conclusion, institutions over the last year buying a little bit more than selling, and we also noticed the same for the more recent quarter. Always remember to do your own due diligence. Now, in terms of this company's balance sheet and income statement, we're going to take a look at their revenue and net income first. What we can in fact see, as we've discussed, their top line revenue is pretty consistent. That's always great to see. They've been increasing their top line, as we mentioned, nearly 3 times from 130 to 372 billion. But what we didn't identify was what does their bottom line net income show us, and that is an absolutely gorgeous thing to see. That consistency not on the top line but also being reflected on the bottom line, which has gone up in fact nearly 4 times from 5.6 billion in 2014 to 22.4 in 2023. So we're seeing lots of good signs with UNH. And then we move on to the balance sheet, where we want to highlight here the health check. Very quick, total cash versus total debt. Similar to all of the other metrics, their cash position has been increasing, and in fact we see it go from 7.5 billion to 26 billion in the latest quarter. Now remember, with these metrics in isolation they don't tell us anything, which is why we flag this in comparison to the movement of the total debt numerically and directionally. Unfortunately, like revenue, like net income, like cash, their debt is also consistent and increasing, which isn't typically what we want to see, going from 17.5 billion in 2014 to 75.1 in the latest quarter. But do remember that essentially the net debt to EBITDA that we saw was around 1, below the maximum levels of 3 that we want to see. So far it does look good, something though just to keep an eye on. Now we're going to take a look at some gradings. The first one, valuation, where they get a D-. In terms of the forward P, well, right now around 21.86, but when we did take a look at the updated data, it sits around 19, and the sector is around 21.4. So in fact, given the drop today, as this hasn't yet been updated, UNH is trading at a discount to the sector median, and I do believe if you take a look at pretty much the majority of the different valuation methods, this is what the same result would be. So whether or not you believe it deserves a bit of a discount, whether or not the market has overreacted, that is something that we do need to conclude in today's episode. In terms of the growth, well, they get a C-, year on year 10.6, a lot better than the sector at 6.82. Forward looking around 10%, again a little bit better than the sector at 8.36. But when we take a look at the earnings per share over the next 3 to 5 years, it is anticipated to grow at 14%, which is again better than the sector of 11.34. So it's trading less than the overall sector at a discount, but in terms of growth, it is marginally better. So that is a good sign that we could have found a nice opportunity. And profitability, they get an A+. Gross margin looking pretty poor, 24% versus 58% of the sector. Bottom line though, it is looking good to see at 3.7, given the sector as a whole is trading with a margin of -5%. And the one thing that really stands out from this company, their cash from operations are huge, 9.6 billion, a lot better than the sector of -14 million. That is in fact a loss on a trailing 12-month basis. Now, quick conclusion for this part of the analysis: a buy from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, D- on valuation, C- on growth, with an A+ on profitability. Now, before we jump into essentially the valuation model, a few things just to highlight. Let's compare their performance against others in the sector. We have ELV, CNC, HUM, some very large names that I'm sure you've heard of. Over the last year now, with the drop, UNH is still one of the top performers, but this highlights that the industry as a whole over the last year hasn't really performed that great, so it's not really due to UNH in isolation. As we can see, this is a sector-wide issue. In terms of the last 5 years though, that is a very strong performance, up 173%, one of the best as well. And when we expand over the last 10 years, up 639, including dividends reinvested, one of the best performing, very, very strong. So this is definitely one that has historically performed very well. Although it is important to note that past performance will have no impact essentially on the future performance. Now, we also want to just highlight here that this company over the last year has struggled against the S&P 500, but when you do zoom out over the last 5 years, we see it outperforming, and over the last 10, we also get the same performance. Question you have to ask yourself is, do you believe it will outperform moving forwards, or is this one that maybe you lack the confidence in and could possibly consider investing in a low-cost ETF? Now let's jump into our own valuation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So how we got to our $600 intrinsic value, we ran it through 3 models. The first one, multiples valuation, companies in a similar sector and size that we just reviewed, the average P multiplied by the EPS of UNH to give us our first overvaluation signal. Do remember though, we don't look at any one of these models in isolation. We then move on to the dividend discount model. Average growth looking very strong, as we already discussed. They do increase their dividends at a very good rate. Moving forwards, we've gone a lot more conservative at 6.75, where we get our first undervaluation signal. We then move on to the final model, the DCF model. Free cash flow year on year, average growth 17%. Moving forwards, we've gone a lot more conservative at 7%, lower than the average growth rate, lower than the previous year at 10%. With the discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and as we can see here, a second undervaluation signal. And in today's episode, the intrinsic value is the average of these 3 models. Now remember, on this channel, we always use a margin of safety, which we start off at 10% and execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, in today's episode, a buy at $540, it isn't quite there yet, at the 5% around $570. So today it is around the 5 to 10% level, and we would believe that this is a high quality company, so you could perhaps dollar cost average in around the 10%. For those that want to see at 15%, a buy at 510, at 20% around 480, and at 25% 450. As we said though in today's episode, somewhere between the 5 to 10% mark, with Wall Street giving this upside of 12%, $626 price target. Remember, they did give this a strong buy rating. As always, give us your thoughts in the comments below. This is one that we also, as mentioned before, hold in our bond portfolio, and we will be taking a close eye at the price if it does continue to drop, to continue adding into our portfolio, as we do believe over the longer term, like it has historically done, there are no reasons why we don't believe at a bare minimum it can keep up in line with the S&P, if in fact not outperform. As always, give us your thoughts in the comments below if you're looking to add, maybe looking to sell, or in fact this is one you're just looking to hold. Don't forget, you can also grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is in fact for UNH or any others. And also don't forget to sign up to the free weekly newsletter and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.